Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, July 20th, 5:35 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in an uptrend. You can see by the four arrows over here, market leaders acting bullishly, but quite a few in the tech sector took a hit today. The question is it normal action or cause for concern? That's going to be the theme for today's video. We'll take a look at multiple charts and try to determine, is this a normal pullback after some strength, or is this something to be more concerned about? From the good news on the can't argue with the fact that all five of the major indexes are trending above their short-term 21-day, medium-term 50-day, and long-term 200-day moving average. NASDAQ 100 broke below 6% today on its broke less than 6% extended from its 50-day moving average. So that pullback that we've been looking for weeks, we finally got it, and it took disappointing earnings from Netflix with their guidance and from Tesla with some ambiguities about when exactly Cybertruck would get into production and when, and they also alluded to some slowdown in production next quarter due to some plant retooling. So the reaction was to sell. These things had nice gains, and those two definitely had a change in character today. We'll take a look at those charts and assess them along with the others. So, bottom line on the day, what just happened? Leaders hit hard. Yesterday, the leaders took a break. Money flowed into low beta sectors. Today, leaders absolutely took a hit. But continued rotation into lower beta or safe sectors led the Dow to have a positive day and also minimized the damage on the S&P 500, despite the three tech sectors being down, seriously down. XLC down 2%, XLK down 2%, XLY down 3.4%. So picture Chucky with the knife. XLC, XLK, XLY. I affectionately or sometimes not affectionately refer to them as Chucky. RG8 leaders, tech leaders, growth leaders, not leaders today, hit hard, down almost 2%. S&P 500 down 0.7. NASDAQ 100 down 2.3. Dow positive, as mentioned. Mid caps down 0.5%. Russell 2000 down 0.9. Global diversified 60/40 stock and bond down 0.6. In-house GROTECTION took a hit, with Tesla being our second biggest position, and that carrying over to really the entire growth sector, which is for the most part the pond that we fish in. Not really hard hit by the rest of them, but a decent enough hit, including NVIDIA, our largest position, to underperform the S&P on the day. Let's get right into it. We'll look at charts. We'll look at the tail of the tape. But first, let's take a look at, and remember the theme of today, is it normal or is it cause for concern? Now, this is the second biggest down day on the NASDAQ 100 of the year. The NASDAQ has very clearly been the leading index. Relative strength, it has calmed a bit, which is on the good side, was what we were looking for with all of our comments on how extended it had been. It broke out. So the first breakout, there's been multiple breakouts here. The first one was back here. The second one was here. The third one was last week above this 372.85 level, and we retraced the 5 days of gains, most of the 5 days of gains in today. So that's kind of called a 5-bar break, and it's not good. And we broke below the ADMA. Now, by itself, that's not a problem. Volume was higher on the NASDAQ 100 today. We still have the rebalance hanging over the head, and it's an uncertain thing because the NASDAQ has not come out and announced what the target um, percentages are. They were supposed to do that after last Friday's close. They take effect on Monday. In other words, in 2 trading sessions, but still no insight into that. Maybe that has something to do with it. Early in the day, uh, Tesla was down, Nvidia was down, Amazon was down, but uh, several of the other big seven were holding the index up pretty well, and it wasn't a serious cause for concern. That didn't last long. That lasted, maybe 30 minutes, and then you can see one leg down, a weak attempt at a bounce, a second leg down, going sideways, not even a bounce, a third leg down, and then a little bit of a bounce into the close. Uh, the action intraday on tech was terrible. There were no bids really on any of the seven. By the end of the day, all seven were down. Nvidia down 3.3, Tesla down 9.7, Microsoft down 2.3, Apple down 1%, Amazon down 4, Google down 2.3, Meta down 4.3, and then we'll throw in Netflix since they reported yesterday, and let's show that chart. That was down 8.4%. Now, Netflix, this is a serious cause for concern. Uh, First, the volume, 233% above average, down 8.4%. They warned on next quarter, and it broke the 21-day moving average. So very clearly a failed breakout, major change in character for Netflix on this chart. And with that, coupled with the volume, it will probably take some time to repair. If it doesn't, that tells you even more about the market than today's action does, because if it repairs quickly, then the market is stronger than even I'm giving it credit for, and it has been pretty strong. Keep in mind, we're headed into a week and a half left in July. July is typically a stronger month, but the last half lags a bit in election years anyway. And in August and September, the weakest parts of the year. The market needs to cool down. It deserves to cool down, and this may be the beginning of it. And that's what we're on the eye for. So we'll consider today an inflection point day, and then we'll reference that inflection point day. Here's the S&P 500. This doesn't look in any way, shape, or form like an inflection point day on the S&P 500, and that's because we had 6 sectors up, 3 sectors down, and one close to unchanged. All that money flowing into those 6 sectors from the big 3 sectors. Let's go through those big 3 sectors first of all. We'll start with XLC. This is communication services, down 2%, still above the 21 EMA, gave up the breakout. This doesn't look like a breakdown. But if you look at the relative strength line is now below where it was while it was basing. So from a relative strength standpoint, we're starting to see more underperformance in tech-related sectors. So XLC, that's your Google and your Meta, which haven't reported yet, obviously. Let's go to XLK. Here's the tech sector. This doesn't look particularly bad either, down 2%. Broke the 80 EMA, still trending above the 21 EMA. We're going to kind of give these the benefit of the doubt until they break the 21-day moving average, and at this point they haven't. Now we'll look for additional weakness, and we'll look for how not only the big seven act, but how some of the smaller growth stocks act, like the AI software leaders. Let's look at XLY. This is the very clearly the worst on the day, down 3.4%. So this is where Tesla resides, consumer discretionary. This is also where Amazon resides. Now, Amazon being down 4%, a lot of that impact is because of XLY getting hit by Tesla, because it's such a big part of XLY. Tesla and Amazon both are. It kind of carries over to that. So I don't know if Amazon's 4% down day today is strictly an Amazon move, or if it was impacted somewhat by um, more by Tesla than it was an Amazon. But the bottom line is failed breakout for Amazon above this level that it had been basing about on for about 3 weeks, but sitting on the 21-day exponential moving average. So on an inflection point, we're going to reference today's lows for just about everything. And you notice what we're going to see a lot of is that on a daily chart, a lot of these stocks have been in overbought territory for multiple weeks. So let's just fly through those big seven very quickly. We're going to start with Apple. Apple held up the best today. Just pull back to the ADMA. Looks great. Earnings in 3 weeks. Uh, Still fighting the possibility, not the possibility, the absolute fact that it's going to have a reduced percentage in the NASDAQ 100. So there you got Apple. Next up, Microsoft. Microsoft pulled back further recently, but regained the strength. Had some positive news 2 days ago, but gave up all of that news driven move up. It was based on AI on the pullback to the ADMA. Note the RS line, or the stochastic line, rolling over off of overbought. Next up, let's take a look again at Amazon, which we pointed out it had been overbought for a while, now starting to roll over also. Let's go to Google next. Google was the weakest for quite a while, had a 4-day stretch where it regained a bunch of strength, but over the last 4 days, it's given up most of it. This is not a good sign here for Google, breaking back below the 21 and the 50-day moving average. And it is the weakness before Tesla today. It was the weakness of the seven. Let's go to Meta. Very smooth trend up by Meta. This is a thing of beauty, riding the ADMA going back to its last earnings report. They report next week. It's been in overbought for multiple weeks, still holding the 21 EMA. The 21 EMA is very clearly your reference on the health of Meta. NVIDIA, really the number one stock in the market since its last earnings report, and setting the tone for all the other AI stocks that did well, rolling over, but it rolled over back here too. Never broke the 21 on the rollover. So basically, it's sitting on the 8 EMA after the pullback, and still above the 21-day moving average. You've heard me say you can't complain with anything that's trending above the 8 EMA. You can not really complain if it's above the 21 also, and that's really the line that we use, but we will monitor if something gets very extended and it breaks the 8, because the next level down that we keep track of is the 21. So this hasn't failed the breakout from last week yet. And really on the chart, this doesn't look like, I'm going to get rid of stochastics here. It doesn't look like anything abnormal. We had a very similar pullback a couple days last week on it, regained most of that loss in 2 days. Now we're back where that was. The gap up, this 440 level, is the reference point for NVIDIA as to whether or not it may correct more. By tomorrow or the day after, 440 is going to be where the 21-day exponential moving average is, so that'll provide another reference point. Now, NVIDIA has not broken the 21 at all since its last earnings report. Doesn't report until 8/23, so the 21-day moving average will be a very key level for that. Already discussed Netflix. This will be the 8th one, and how that broke the 21 today, and don't like the look of that at all. So let's go to something which I do like the look of, the Dow Jones Industrial Average. 8 sessions up now, 1, 2, 3, 4, 5, 6, 7, 8. So this is a breakout. We had alluded for quite a while to the relative weakness here. Now you got to point out the relative strength. I didn't know when it was going to happen, but today's the first day that it broke back above the 21 EMA of the relative strength line. And this is the quote unquote safe index. And it's obvious that from the relative strength line of this and the relative strength line of the NASDAQ 100, where the money's going to. It's going out of growth, which had a big run, and it's going into the Dow Jones Industrial Average and the safer sectors. Now let's discuss safe sectors for a minute. We'll go with SPHB first. This has been the high beta, and this has been a big leader this year. Broke out of the cup and handle, had a break down 2.2%. By itself, this really isn't a big deal. I mean, it just had 5, 6, 7, 8 out of 9 up days. But then when you look at SPLV, which has been the big laggard, and see the big breakout on SPLV and the big change in character on the relative strength line, that is a little bit more to be concerned about because it's very clear that the money is flowing into these low volatility sectors. Now that'll boost the S&P 500. This is why we keep a big um, SSO position. It's like 31% of the portfolio, which is the equivalent of having 62% in the NASDAQ 100, because all this rotation takes place within the S&P 500. Money coming out of Chucky, XLCK and Y in a big way today, just scattered among. When you see the other sectors up, that tells you that there's rotation that's taken place and not money leaving the market. That is probably the biggest check in the market health column from anything that I can take away today, is that money's not leaving the market. It's just rotating into safer sectors, and maybe in anticipation of seasonal weakness, maybe in anticipation of the reaction to tech earnings, maybe just money coming off the table after a big run in tech. But to me, the biggest takeaway and the biggest check in the bulls column has been the fact that uh, the money went from the tech sectors into the other sectors within the S&P 500. Let's flip the mid caps now. This is another positive takeaway. These did not fall apart today in any way, shape, or form. They're still riding their ADMA higher. Can't complain when something's riding the ADMA higher. It's a natural, uh, ultra low, ultra short term indicator for health. And this is saying short term, this is fine. You can't break the 21 without breaking the 8 first. And MDY is continuing to show the strength. So while that money's coming out of the big tech, is it flowing into the small cap tech? Well, let's go to IWM also, small and mid cap. A little bit of a harsher pullback, down 0.9% today, but this is very normal in context of the run, very strong run that we had from 182 all the way up to 198-ish. 1 day pullback of 0.87% and still above the ADMA. That's another positive takeaway. So you've got mid caps acting fine. You've got the Dow leading from a rotation standpoint. You've got money flowing out of the NASDAQ 100 and the tech sectors and flowing into other sectors. Uh, that's normal, but that doesn't take away the fact that it was extremely harsh today on some of these growth sectors. And let's quickly go through the RG8 to gauge that. IWO, normal pullback so far, still holding the ADMA. SP SLYG, small cap 600 growth, just down a percent. That looks normal. MDYG, mid cap growth, down 0.34%. That looks normal too. Now remember, there's multiple sectors within here, so rotation coming out of small and mid tech can be going into small and mid value. So let's check those. MDYV, down 0.70% today. So across the board, mid cap was down. Let's look at SLYV. SLYV down 0.54%. So more of a complete pullback, but not as much of a rotation going into the safer sectors. If you look at SPYV, this is the S&P 500 value. That was even down a little bit, nowhere near as much as the growth side of it, SPYG, which was down almost 1%. So very clearly, uh, money coming out of the growth big cap stocks, which we already alluded to by uh, not that shouldn't be a surprise for anybody after looking at XLCK and Y and how they reacted today. Let's continue with the RG8, and here's where things start to get a little bit worse. The IBD 50, this is 2 down days now, down 2.8%. This is the leadership stocks. This is the pond that we fish in. Broke the ADMA, so that's a negative coming into the 21 EMA. So definitely a negative there. And the other big growth one, ARK-K, this has a massive position in Tesla, so it's not a surprise that it's down. Down 5.71% is pretty harsh, and it also broke the ADMA. But in context, look at how it was up 8 out of 9 days. So uh, the bottom line here is that yes, it was a harsh break, But in context of the recent run up, it's considered fairly normal. You haven't even given back half of the move. Let's look at the last couple of members of the RG8. QQQJ down 1.3%. That looks like a fairly normal pullback. And PDP down 1.4%, harsh, breaking the ADMA. But we won't ever be able to say for sure until we see the action Monday or Friday and Monday, whether or not today was a true change in character for the market. All we can do is focus on the lows of the inflection point day, which was today, see if they're broken decisively. And stick with your stops on individual stocks. We're going to go through the entire portfolio here and discuss what the changes that we made today and some possibilities going forward. The other member of the eight is SPHB, which we already looked at, and that broke the ADMA also. So very clearly, the RG8 hit harder. Whether hit harder today, you prefer general pullbacks, you don't always get them. But we did have a very strong run up on this RG8, and we haven't given back half of that move yet. The market is always entitled to give back half of a move before continuing higher. But uh, there will be some cause for concern as we continue going through some of these individual names. But for now, let's continue. We're still in the first part. We haven't even gotten to the tail of the tape yet. So let's close that. The VIX not really showing any concern at all. Bouncing, still closing right on the declining 21-day moving average. You would have considered it to be up more. I would have thought it would have been up more than 1.7%. But again, this was really a tech centered sell off today. Let's go to the dollar. This didn't help things either today. The dollar up for the third straight day, back above the 80 EMA, still below the 21 EMA. That again, the dollar hasn't recovered half of the losses that it went down. So for now, and until it recovers more than half and gets back above the 21, the trend for the dollar is still down. That doesn't help gold and silver stocks. Here's gold down 0.5%. That looks like a very normal pullback though, since the breakout of the bull flag 2 days ago. Normal pullback for that. Silver has been stronger, but down 1.82% today, but really hasn't given back much, still above the 80 MA. The one that got hit hard today was GDX, sitting on its declining 50-day moving average. You never like to see a declining 50-day moving average because this can just keep continuing lower. And the price can continue following down. So for now, we don't like that it broke below the 80 EMA. We like the fact that it's still above the 21 EMA and it hasn't given back half of its move off the low either. We're back to a slightly negative position in our nugget gold position, which we bought on this first day of the move up in the break of the 50-day moving average. We added to it on strength. 2 days of a pullback now has put us slightly underwater on that. Let's go to Bitcoin. Bitcoin and the Bitcoin miners down today. Bitcoin down 1%. This is frankly disappointing. Needs to hold this 50-day moving average and get back up and show some strength in this handle after what looked like a change in character the middle of the last week. Is looking like just a one-day wonder bounce now since we made lower lows since then. Let's flip the bonds now. This didn't help the market either at all today, and that's rising interest rates. You can see BND, the broad index, down, but again, it's down after a pretty big run up uh, back into the broad range. Failed breakdown clearly, but when it bounced back, it couldn't change trend. It just got to the top of the range now. We'll have to see how bonds act going forward. TLT, the long bond, this is a pretty decent size move down, 1.2%, but in character after a 6 or 7 day bounce, that's a normal pullback also. But a fail into the declining moving averages, we don't want to see this go back below 100 because that would mean that rates are breaking back out and higher rates are not good for stocks. So here's TNX. Here's the failed breakout. This is the 10-year yield pulled down to the declining or to the uprising 50-day moving average and bounced off of it today. We don't know if this is a one-day bounce or if this is going to test the highs of the yields again, but that again is something that we definitely have to look for. TYX, the 30-year note, bouncing at the 200-day moving average, failed breakout again. This is a fairly tight range, and it's just back to the low of that range again. So this could go in either direction, and that definitely is something that we have to keep an eye on also. Let's look at the equal weight indexes, and this will reiterate how this was a big tech centric sell-off today. Here's the equal weighted S&P 500 just barely down today. No inflection point look in any way, shape, or form there. And QQEW, the equal weighted NASDAQ, down 1.15%. Just to pull back to the ADMA, that looks a heck of a lot better than the 2.3% down move in the NASDAQ 100. That was a pretty lengthy intro, but there were a couple of things that really needed to be stressed there, and we need to proceed now through the tail of the tape. So one thing that I need to highlight here, and this isn't a good thing for bulls, the AAII sentiment. And again, this is a contrary indicator, but it's kind of reliable. Bullishness was up 51.4%, up 10 percentage points. This is the high of the year. It coincides with the high in the market yesterday. And it's a fairly reliable indicator of tops. Anytime you look back, highs and lows in the AI bull and bear percentage correspond with tops in the market, so or bottoms in the market. The low or the excessiveness in bears corresponded with the low being put in last October in the index. So this is definitely something from a sentiment standpoint that we need to pay attention to. That's the highlight there. The stochastics are going to mixed from bullish. And the day count, we're up 7 out of 9. That's a 33-day rally. That's a pretty strong rally. You know we don't go up forever. The more this count gets higher, the more likelihood is that the pullback's going to happen. Can't say for sure that today was the day of a pullback. The first day of the pullback, are we going to continue to make new highs? We let the market gauge that, but we will stick to our stops and the market will take us out and lock in the majority of the 15+% profits that we gained over the last 7 weeks or so. 8 days above the 80 EMA, 38 days above the 21 EMA. And actually, if you count 1 day shakeouts on the S&P below the 21, we're over 50 days above the 21 if you exclude those. QQQ down to 5.9% extended from the 50-day moving average. We held this 4,500 to 4,535 support resistance level in the S&P, but we broke the 382.86 level. That was the breakout level. Broke below it today on the NASDAQ 100, closing down at 376.76. So I already commented on what was up for the day. Most of the other sectors, basic materials, energy, financials, industrials, staples, utilities, and healthcare on the downside. Picture Chucky with the knife, XLC, XLK, XLY, semiconductors, gold, especially gold stocks, software, cloud stocks, and home builders. ITB, I'm gonna point one out here before I forget. DHI was up big pre-market on earnings. It reversed hard, but it did bounce at the 21-day exponential moving average. This is another possible inflection point. And you see we have our alert for a low set below today's low on the DHI, which corresponded with the 21. Nail, which is the ITB leverage, took a big hit today, down over 8%, but it also bounced at the 21. This is 2 times the ITB. ITB didn't quite make it to the 21, gave back most of the breakout that we saw in the indexes from last week, down 2.64%. So, and volume was on the higher side today on these. Toll, the leader in the 21 over 21, broke decisively below the 21, got close back up to the 21 by the end of the day today. We'll see if it can reclaim it tomorrow. So that was definitely one of the things I wanted to point out was the builders. What we do in-house? Well, Celsius continues to lag below the 21, although above the 50-day moving average. So we trimmed a third of that. on a lack of strength and relative weakness. Chart looks okay, but it's just really not making any progress since it got above this 140 level. This 140 and the 50-day moving average, a very key area that I would expect to hold on any additional pullback. We do have 2/3 of our position remaining on that, and we're basically flat on it. Trim Tesla. When we broke below the 21-day moving average, that's when we took off. We've had 3 buys on Tesla. 2 of them were in the 190s. One was 190, one was 196. The third buy was at around 247. We sold the 247 buy today, and we also took recent shares off that we bought for any new clients that came in this area here, as those are now underwater. So for Tesla, what we want to monitor is today's low, the 21-day exponential moving average. Uh, the gap has been filled, so this really needs to hold this 260-ish level in order to stop going down. But this very clearly looks like an inflection point change in character day for Tesla right now. But again, like I said, if it recovers quickly, then the market is stronger than I have been even giving it credit for. And then we hedged when the Qs broke the ADMA and also started to give up that 379-ish level. Which was the ADMA. That's when we put on a 5% SQQQ hedge. The first target for this would be if we got down to the 21 EMA on the Qs, we would take profits on this and then assess all of our positions as we do every day, but also assess the health of the overall Big Seven, because that's going to drive the S&P 500 and it's also going to drive the NASDAQ 100. And then we want to look at where the recent tech leaders, which got hit hard today, how are they recovering? So this is the lightest we've been in weeks, 1.56% volatility adjusted beta. And the bottom line for the day, tech growth leaders hit hard, more money flows into safe sectors. Possible change in character, definitely a change in character for some stocks, possible change in character for the NASDAQ 100. But plenty of other things left completely unscathed. Now let's take a look at some of these AI software stocks and other AI leaders that got hit hard today. Net, not a good day. Big reversal, down 7.5%, still sitting on the 21-day moving average. To me, that today's lows are pretty critical for that. I'm really focusing on things that were down 5 or more percent. IoT, I don't think that this is even a 1 ATR move, but it did close slightly below the 21. This is a very volatile stock. Let's see, Palantir, ugly last couple of days. This is what you're seeing on a lot of these. Now, look how big this move up was over the last couple of weeks. Taken in context of that, this is a normal pullback, but it's a very harsh pullback. As long as you're still above the ADMA, you're fine. If you're breaking the 21, there's more of a cause for concern. So Palantir, that's a harsh pullback, but still sitting on the ADMA and also right at the top of the recent breakout area. And volume was below average today on Palantir. Datadog, not quite down 5%, but 4.6%. You're seeing a lot of these 2-candle combos. Those are evening star patterns. What happened at the end of a strong run up, and this one's still on the ADMA. And as I said, can't complain about something sitting on the ADMA. MDB, recent leader, just back to this breakout level above the 410-ish level, sitting on the ADMA, still above the 21 EMA, and really that 400 area was first the breakout, then failed, that was reclaimed. So with the 21 being there, that's a very key level for MDB. We own this in the portfolio. 2 harsh days. We're back to even on this now. Failed breakout, broke the ADMA, still above the 21. Little more than a 1 ATR move down on Unity. We have a small 2% position on that. And besides Tesla, this was the only other one of our stocks that was down significantly today. So we're going to blast through the portfolio. and take a look at whether or not things are normal, above average, or abnormal. SMCI uh, closed like a champ, like Secretariat in the Belmont, closing near the highs of the day, barely down. For a AI hardware stock, that's a pretty good day, reclaiming the 300 area and the ADMA. We already showed you Celsius. I showed this. We sold the third, languishing under the 21, but above the 50-day moving average. Uber, one of our top four positions, just a normal pullback to the ADMA, down 1.2%. DT, mildly concerned about this, pulled back to the 21, gave up the entire breakout move that happened on the 11th. Not a good sign there. And we still have gains in this, but it's starting to not outperform the S&P 500, which you can tell by looking at the relative strength line since the breakout. And we want things doing twice the S&P, not below it. Live Nation positive today. Just Camp continuing to ride the 8 EMA higher. I showed Tesla, I showed Nvidia, and that's the portfolio nugget. We still have uh, that, and I commented on the status of our gains for that. And then finally, NRGU, which we're slightly positive on. Oil stocks continue to hold this breakout. Tested the 21 3-day bounce off of oils. So that's looking good there. So that's the entire portfolio, down 1.66% on the day, gave back some recent gains, especially in Tesla and Nvidia. For the most part, what we're holding is still acting well. The concern is with the NASDAQ 100, obviously, and the Big Seven. And we got to see the rotation that took place, to me, is a positive. Um, but we can't continue to see serious deterioration by the growth leaders. Let's take a look at a couple more that had big down days today. Coin, recent breakout, still holding that ADMA above the 100 area. DraftKings holding up pretty well. The breakout. This is one that gets a definite big thumbs up for its action today. We don't want to just talk about things that had a rough day. Upstart, very strong stock, finally giving it up. Uh, Down 5.2% after a fantastic run. And let's finally talk AEHR, which had this big move up, gave up the 50, gave up the high volume close on its earnings report, but did hold the ADMA if the market rights itself and semiconductors can hold up. This can certainly be a potential leader. One thing I didn't mention, but was an overall negative, Taiwan Semiconductor was very bearish on their outlook, with the exception of AI chips, down 5% on their earnings report, was forming a base, broke below that, broke the 50-day moving average. Uh, we want to see that. I'm going to set alerts at the range of TSM so we can see if buyers come into this or if semiconductor equipment companies continue to get sold. This is an extremely long video, but there's a lot to go over today. Is definitely possibly a key, definitely possibly, right? Can I hedge it anymore? You never know anything for sure in the market. It's a market, it can do anything it wants to. We take a look at the clues, whether they're positive or negative. The weight of the evidence is how Stan Weinstein would term it. And several of our stops have gotten hit. We reduced some holdings. We've got our lowest beta that we've had in a while, and that's a reflection of lack of follow through in some of the things that we're in, and also some relative weakness. But I'll finally stop talking now. And remember, it's not how much you make in the market, it's how much of that you can keep. That's why we do what we do here at Revere. Feel free to reach out to me, Don at revereasset.com, or the phone is 855 Real Wealth. That's 855 732 5932. And with that, I'll finally wrap up the daily market insight video for Thursday, July 20th. This is Don Vandenbord. Just the facts here at Revere. Thanks for listening and have a great day.